Good morning to our advisors, investors and shareholders in APL, and thank you for joining us today. For those of you who I haven't met before, my name is Alison Savas and I'm the Client Portfolio Manager at Antipodes. For the first time in a decade, markets are witnessing large-scale coordination of both fiscal and monetary policy across the world. With wealth disparity continuing to widen and social discontent emerging, the pressure on governments to do more is building. Today, Jacob Mitchell, CIO of Antipodes, will take us through what the stages of reopening might look like and the challenges the major economic blocs may face along the road to normalising economic activity. So let's get started. Jacob, with economies starting to reopen, how has your understanding of COVID-19 evolved in real time?
Thanks, Alison, and welcome to all of our investors and shareholders in APL and advisors. Look, it's sometime into this pandemic, we've all had been on a fairly steep learning curve. Look, I'm just going to go straight to the table and say, look, at a population level, most countries have experienced roughly a 1% infection rate. Now, the interesting question is how, out of all those people who weren't tested, how many actually were infected and had, a so-called asymptomatic experience with COVID-19, i.e. they displayed no symptoms. Some of the early serological studies suggest that could be a ratio of 10 to 1. It's still very much unknown. So what does that mean? It means the fatality rate was probably lower than 6.9%, the average across those countries. So I think governments and policymakers will take that into account as they reopen. Now, the fatality rate is still high, but it was concentrated in more vulnerable demographics, elderly, those with comorbidities. And our view is that the reopening will be somewhat permanent. We think even in the situation of a second wave, we think there'll be a lot of pressure from society to maintain a reopening. Hard to know, but it is, I think, going to be more of a situation going forward of learning to live with COVID-19 until we have, until there is a potential, vaccine, but that isn't guaranteed. So it's going to be maintaining some of the policies we've had in place, but less pressure on individual industries. We think there'll be a lot of pressure to bring back travel, normalization of travel, leisure, retail, but with some, let's call it, continuing ongoing social distancing.
Now, we've been talking about a rise in populism around the globe for a while now. How has COVID-19 added fuel to this fire?
Look, we think in some ways, given that it's really hit in terms of the unemployment increase, has really hit lower income demographics. It is reinforcing populism, and it is, leading governments very quickly to this second last bubble, fiscal activism, debt monetization. So, in the 10 years since the financial crisis, most of the QE wasn't really funding deficits, not until more recently in the US, but certainly not in other parts of the world. So we think there's a more chance of a, let's call it, genuine regime shift, where it's seen as acceptable to print money to fund direct government spending. Look, the longer term implications of that are many. I think ultimately our long-term view has been that populism ultimately emerges as a more, let's call it, a less forgiving environment for inflation. It's not the time to have that longer term discussion, but that's where we think we're ultimately iterating.
Now, we all know the market is celebrating a small number of winners. What do you think happens next?
Yeah, look, it's quite astounding that, year to date, this is the data for the US, but this pattern is broadly the same across the world. But year to date, something like 85% of the move in the S&P is explained by, I think it's, 4 stocks, 5 stocks, and there's no guessing what those 5 stocks, no prize for guessing what those 5 stocks are. So what are we looking at here on this chart? So the dark blue line is the percentage reading off the left-hand axis, simply the percentage of stocks that are actually outperforming the index. So it's a measure of breadth, market breadth. So very, very narrow. Now the yellow line, conversely, the winners keep getting larger as a percent of market cap. So market cap concentration has broken out to a new extreme level. And it's HHI. We explain how we measure that. It's in the footnote there. And then the dark blue line is just to measure the rolling performance. Sorry, the grey line, the lighter grey line there is just the rolling performance of a sector neutral value bucket. So how have lower multiple stocks performed on a sector neutral basis? I think what's interesting is that you tend to get turning points when market cap concentration gets to extreme and breadth gets to this very, very narrow level. And we think we're at, potentially we're at one of those turning points today.
So clearly the winners have not been in the more cyclical part of the market.
That's probably the understatement of the decade. If you look at this slide, slide 5, and you look at just the dark blue line, we're measuring on a composite valuation basis. So we're not hiding in price to book. We're using a composite of different valuation techniques to look at how the market's pricing the more economically cyclical sectors or sensitive sectors versus the more defensive sectors. And you are now on that basis, more than 4 standard deviations cheap in that part of the market. Now the yellow line shows you that historically there's been a degree of correlation between the outperformance and underperformance. Outperformance from cyclicals as economies have recovered, tending to underperform as that growth, as the economic growth goes into a down cycle. And arguably, since the financial crisis, that has a downward sloping line. So the question would be right now, even if you have a longer term view that due to technology, demographics, any number of longer term secular trends that you want to be in growth stocks or defensive stocks, there's a very good argument that you're potentially not buying them at the right time or the right price right here, right now.
So initial stimulus policies have focused on protecting household incomes, and it's been most extreme in the US. But given the social discontent we're currently seeing, how hard will it be for US policymakers to withdraw the stimulus?
Yeah, look, the US response to COVID-19 was dramatic at both a fiscal and monetary level. When we think about Europe and the US, Europe is more bureaucratic. The US is more, let's call it capitalist. But interestingly enough, or sort of, inconsistent with those views, the Europeans or European Union has tended to adopt a policy of paying companies, similar to Australia, paying companies to maintain levels of employment. Where the US has gone down this path of actually, maybe due to a lack of thought, have tended to make it more attractive for companies to sack employees due to the attractiveness of the unemployment benefit. The $600 per week top up to the unemployment benefit. And the implication is that those who have, at an aggregate level, we actually saw since COVID, aggregate personal income has actually increased by 10% as a result of these top ups. And the roughly, if you look at the chart on the left, we're showing in the very first column in leisure and hospitality, but you could also add retail. That's where almost 38% of all the jobs lost have been lost. And because of that $600 top up and the fact that those industries pay so little, those individuals have received currently receiving 2.4 times their wage as they wait to get their job back. So the question would be, now that expires at the end of July. Given the degree of unrest in the US at the moment, we think there's a high likelihood that that will be extended until there is a lot of confidence around the sustainability of recovery. And not only the sustainability, but that recovery leads to job creation. We need to find 30 million jobs to get back to where we were pre-COVID. Now, when you look on the right, obviously a lot of this increase in income is now going online. So we're not necessarily creating jobs at the same rate. Look, Amazon is employing, is employing people, but they're employing them at roughly $30,000 a year. Now, this social wage is currently at $50,000 a year. So, unless it gets withdrawn, some of the workforce participation rate may stay permanently lower, or the minimum wage will have to increase, and there will be a lot of argument, debate. The Democrats will be under, I think, a fair amount of pressure to support a higher minimum wage coming into the election. Is that going to be inflationary? I don't know. I mean, it's very hard to know. But if participation rates fall and pressure for a higher social wage increase, then there may be more inflation than we think starting to build in the system.
So is income stimulus alone sufficient to generate a sustainable economic recovery? Or where do you think we go from here?
Look, we're of the view that, income stimulus is simply a transfer payment. So you're, using deficits, you're transferring money from the government via the deficit to households. So I think it can only ever be really a short-term measure unless you plan to become effectively more socialist, i.e. you actually take taxes up and you use the taxation system to redistribute income. Look, the US, many people, we'll see what happens. Obviously, Europe already has a system that somewhat does that, but there will be more discussion around that. But ultimately, I think you will need investment spending. As I alluded to earlier, we think some of the parts of the world like China and Europe, which have, let's call it, more of a functioning bureaucracy than what we naturally think of in the US, potentially have the greater chance of getting infrastructure spending off the ground in the short term. We all know China knows how to do infrastructure. Arguably, they don't need much more of it. They probably should be focusing, more on, the billion people who are still living in areas which have got GDP per capita of roughly $5,000 a year. It's essentially giving them a pathway out of, into a middle class life. In Europe, we think decarbonisation is very much a part of their longer term thinking, and the fact that they have a functioning emissions trading scheme and they are moving rapidly to EV subsidies just tells you that they already have the mindset to adopt an investment-led recovery. So we think, the economies who do get there faster will emerge more quickly.
So take us through how you think recovery might evolve, and what do you see as being the biggest risks to recovery?
Look, we're very much of the view that's, if we go to point number 2, you will not revert to the status quo, even in a recovery scenario. Businesses have learnt to do things, with less during COVID. So we think in some areas, employment will be slower to recovery. There may be, going forward, a permanently lower level of business travel, office demand. And in retail, given that, we've seen in a very short period of time, online in the US go from being roughly 15% of total retail to 30% of total retail. it's not likely going back to 15%. So, we are going to see some, if you haven't already built an omni-channel retail business, you're not likely to survive COVID. But many businesses that have built that omni-channel are outside of, are cheap. Amazon is sort of celebrated as the winner, and we think it's justifiably seen as a winner. But there's also many other retailers who have invested heavily in omni-channel, which we think, like a Lowe's, like a Nordstrom, that have been, got significantly cheaper during COVID. Keep an eye on house price deflation. Those parts of the world like Scandinavia, Australia, parts of Canada, which have arguably where affordability is stretched. If unemployment is slow to recover, that could become a headwind. The opening up narrative obviously takes the focus from the stage 1 beneficiaries, which have been, in our part of the portfolio, in the barbell approach that we've been adopting, it's been the higher growth secular growers that have benefited the most from the lockdown. So, in those, that narrow set of winners, obviously Facebook, Microsoft, Alibaba, our pharma stocks. In the case of DIY, where we're all, we're sitting at home and we've decided that we need to put more money into our house because we can't take a holiday. In our portfolio, a company like Lowe's has rebounded hard. On the margin, though, we are starting to allocate out of those winners to stage 2 and stage 3 opportunities. They're the opening out, those companies that have been dislocated the most by the shutdown, or they benefit the most from the infrastructure stimulus, and they're category leaders that come out of COVID potentially with less competition. So what are the risks to this scenario? Look, we do see, most of the monetary stimulus that's gone in, it's gone in very quickly. So it starts to get, some of that stimulus now starts to get consumed by funding deficits. So the liquidity environment may start to ebb. I think, it's inflated the stage 1 beneficiaries. So I think even in that environment, the stage 2, 3 beneficiaries can do okay. Europe and Asia is just, in the domestic part of the market, is very, very cheap. And we think there's pent up demand in those economies because they came into COVID already in a cyclical downturn. And I think they'll, as a result, emerge first. And they all are also more likely to have an infrastructure tailwind. And they are very cheap. Domestic Europe, Asia, and cyclicals, the global cyclicals are cheap. So I think investors need to be more worried about growth and profitability traps at this point in the cycle rather than value traps. Now, the risks, as I mentioned, does the US withdraw some of the income stimulus prematurely without getting to infrastructure stimulus? That's definitely a downside risk, and we need to watch that closely. The escalation in this technology war, the trade war has really morphed to a technology war. We think the risks there are equally weighted across US and Asian equities. It's finely balanced. China wants access to critical semiconductor technology, but the US, the multinationals want access to China's market. Apple, Nike, they have big profit pools in China and they want to maintain access to that market. So there's an argument for a stalemate, probably lots of negative headlines the closer we get to the election, but arguably a stalemate. Certainly as the Chinese economy seems to be rebounding in stronger shape than the US, we don't believe that China will be more as susceptible to a bullying tactics by the US. And then you just have this issue of, ongoing social discontent. And, does that get exacerbated by a potential second wave? Certainly if governments go into a hard lockdown again, it will most definitely. But it also, I think, is highly dependent on the speed at which infrastructure spending replaces income stimulus.
Now, with all that in mind, pardon me, perhaps you can take us through some more details around the portfolio positioning and some specific examples of how you're expressing your views in both strategies.
Yeah, look, this slide we've used to try and communicate separate the global exposure, those multinationals that are competing globally versus the more domestically exposed parts of our portfolio, companies that compete more locally. And, you can see we remain actively skewed towards in the long book. And this is for the long only strategy. This is a good, it's a good proxy for the position. It's very similar, actively skewed towards the cyclicals. Whilst we're underweight defensives, we believe we've found the cheaper versions of those companies, but we are slowly, we are actually on the margin allocating more towards the cyclicals. Amongst the domestic exposures, we're concentrating our investments in areas which we think benefit the most from opening up. And yes, we're underweight North America, but we don't have the same valuation protection we do in these same parts of the market in other parts of the world. And we do believe that we are going to get probably a stronger, more sustainable recovery cycle in other parts of the world. So in looking at that exposure from let's call it a cluster perspective, the stage 1 winners are really concentrated in the social commerce software incumbents cluster and the pharma with pipeline. The stage 2 and 3 winners are in the EV, 5G, cloud enablers, because we think certainly in the case of 5G and EV, it will be part of the government stimulus that we're going to see around the world. China is putting its foot down on 5G adoption, and the US and Europe are starting to see it as a part of their, strategic longer-term advantage in terms of trying to compete against China. So EV and cloud, look, cloud doesn't need any explaining, but EV, you're just starting to see Europe, across Europe, a lot more subsidies coming to accelerate EV adoption. New and old energy in stage, when we're thinking about the transition to stage 2, clearly the banks are a very good play on stage 2. But alongside the banks, we have, companies like Class A mall REIT, like Simon's Property Group in the US, that's become incredibly cheap, for a very high quality portfolio of malls. And we don't believe everything transitions online. And the malls are generally the high quality malls will attract the omni-channel retail winners. You also see, discretionary parts of our discretionary spend exposures like a Tapestry that are very, very cheap and will do better as the economies start to reopen. But what really excites us in stages 2 and 3 are the infrastructure beneficiaries, companies like Siemens, EDF, RWE. And then again, if you want to sort of look at something that's a little bit more cyclical, less secular, old energy, which is a story about capital rationing. It's about supply rationing. It's not about growth and demand. It's about supply being permanently taken out as US shale essentially has been shut off from capital markets and is essentially trying to generate cash flow and as opposed to grow. And those two things are mutually exclusive. The only way they can generate cash flow is to shrink. Consumer incumbents, these are companies which will do well in most environments and are cheap, we think, in terms of maintaining very close relationships with their end customers. And tail risk protection and shorts, which we've tended to move towards, reduce in size and move towards less cyclical expressions. And then at a very high level, you can see from a factor perspective, as a pragmatic value manager, we remain very actively, in cheaper stocks. Our average company is roughly 65th percentile cheap. But for that, we are getting a relatively, an above average growth company, and we're getting a company that has a good balance, an above average balance sheet. And the shorts are the opposite, where the shorts are generally more expensive and they don't have the same growth profile, and they have lower quality balance sheets. In terms of the changes in portfolio composition, we've certainly seen as we've gone through COVID, this is up until the end of March, we have added to a combination of some of the secular winners in terms of some of the Asian internet stocks that became cheap in COVID, but then have outperformed since. And on the margin, are starting to approach their valuation targets. But we've also added to some of the cyclical parts of the market that have been hurt, like the oil and high quality oil stocks, infrastructure and property, which is our more REITs, and then some of the consumer cyclicals. In terms of the net, you can see off the low of February, we've taken net equity exposure from 64 up to 76. And we've been biasing those purchases, those investments towards the higher quality cyclicals in our portfolio. On the global long fund, it's probably worth pointing out that since inception, whilst the global benchmark has returned 53.4%, the Acqui Value Index has returned roughly half of that. A pragmatic value approach is really, trying to be as all weather as we possibly can. But I suppose the issue we've had in the last couple of years has just been how extreme the benchmark has been skewed towards a narrow number of growth winners that have become increasingly expensive, which has been, I think, a style headwind. Well, it has definitely been a style headwind. But the fund has broadly kept up with the benchmark, slightly below, but significantly outperformed that, let's call it the traditional value benchmark. On the long short fund, yes, shorts have been a drag, but in severe drawdowns, the shorts have granted protection. We have actively through COVID as clarity around the recovery has emerged, adding in confidence to parts of the parts of the long book that have been a drag, which has been the more value part of the benchmark of the long book, adding to those stocks, and we'll continue to add stocks, as we get more information around what some of the stimulus, how the stimulus is going to evolve. And really that brings, I think, I'll switch back to you, Alison, for a short wrap up.
So before we jump into answering some of the questions that have come through, let's do a quick recap on the key takeaways. So as reopening accelerates, economic data will trough. However, fiscal stimulus needs to transition away from income protection toward investment to generate sustainable economic activity and employment. Now, as this happens, investors will be open-minded to owning cyclicals and start bargain hunting in the most beaten up areas of the market. But while we have this backdrop of uncertainty around reopening and rising social discontent, it will pay to take a pragmatic approach to value rather than wedding to low multiple stocks, and to take a barbell approach to investment. As confidence around infrastructure stimulus, particularly in Europe, has built, we have actively tilted towards the higher quality cyclicals in our portfolio. Jacob, I'll pass back over to you to spend a couple of our final minutes of the webinar answering some of the questions that have come through.
Thanks, Alison. And the first question we have here is the view on the US dollar, which I think is a very good question, given how big the US dollar is in the benchmark. Look, as we mentioned earlier, we think the fact that the US has come into COVID with a relatively weak fiscal position means I think that you are setting up for a structurally weak US dollar. And there's lots of ways to think about that, but probably the primary one is simply just relative growth. We think the relative growth rate of the world ex-US is picking up. And that is that's when the euro or EM currencies, or the euro or European currencies, North Asian currencies tend to do better in that environment. And that's the skew that we have in the portfolio across a combination of the Australian dollar, the Norwegian kroner. We're roughly, let's call it 14% exposed to commodity currencies. We're overweight Europe, as investors know, which means we're overweight the euro, so we're underweight the US dollar in the portfolio, we think it's early. It's probably that's a sustain. We think the US dollar is on a longer term weakening tack, and we'll take any pullbacks in the Aussie dollar or in the European currencies or North Asian currencies, to add exposure. The renminbi is the wild card, and it probably leads to the next question, which is, what are our thoughts about investing in China, given the deteriorating relationship with the US? And there's no easy answer, but we think, given China's already been dealing with 2 years of, let's call it, trade disruption, the potential for tariffs to have the same damage that they had in the prior 2 years is somewhat lessened, and also the sort of framework of somewhat mutually assured destruction, i.e., if China was to be cut off from semiconductor technology, the US would certainly be losing access to Chinese markets, which is a big issue for some of the largest companies in the US. Tends to iterate towards stalemate, lots of negative headlines, lots of blaming over COVID, and look, a relationship that's far from warm. And I think from a tail risk hedging perspective, there's 2 ways to manage the risk. The first is to maintain some hedge on a weaker renminbi, so it's the one Asian currency we would be less positive on. And secondly, I think it's maintaining some circumspection around what you're willing to pay for a large US multinational that has direct exposure to China. Companies like Apple and Nike, yes, they're very strong companies and they're very high quality, but they're not cheap relative to their histories, and they do have exposure to this tail risk. And I think generally what it means is, and the way we've designed our coverage of the market, where we have both global teams and we also have regionally, let's call it an Asia EM domestic team and a North America Europe domestic team, you need to be wary about companies that have significant profit pools in both markets, because they're the companies that get caught by any permanent rift. So we think longer term, the Eastern sphere and the Western sphere are slowly moving apart, but it's not a black and white, schism. Europe, we think, for all sorts of reasons, because of its very strong dependence on Chinese imports, will remain relatively open to China, and vice versa. But the US is clearly seeing China as a technology geopolitical competitor. Just going to some of the other questions. We've got, what makes, someone's asking, given the stylistic drag on the portfolio over the last couple of years, being a value manager, what changes over the next few years? What makes it different? Look, we think, the regime change argument is somewhat, supported by the fact that at 2 levels, you cannot have a narrow set of companies just built, continuing to take more and more of the profit pool without some negative side effects, whether it's populism, whether it's governments focusing more on regulation and taxation, or is it simply just the issue of competitive intensity, and whether or not you can just maintain your dominance. Now, we believe some of those companies are clearly not going away. We have a big position in Microsoft and Facebook. But we don't own Google, and we do think there's a lot of regulatory risk in that company. We don't own Apple because we think there's quite a lot of geopolitical risk, and ultimately it still has a very high dependence on the maintenance of hardware profitability. There are issues. So be selective, and I think you need to be open to a change in regime where in these desperately cheap cyclicals, you have secular winners. Not everything is about the cloud. Decarbonization is inherently industrial centric. The winners from decarbonization are not Google and Facebook. They're companies like Continental, Siemens, STM, and dare I say, even some of the automakers can make a comeback in that environment. So you've got to play both ends of this barbell, and I think at the moment you should be thinking much more seriously about the, let's call it, low multiple cyclical, but not because they're traditional value, because they're pragmatic value. They have a secular future.
So Jacob, I'd like to thank you for your time today and sharing all your insights. And I'd also like to thank all our advisors, investors and shareholders in APL for joining us today and for giving us their time. So thank you very much.